To understand how we got into this, it's important to first know how the mortgage system used to work. Qualified buyers worked with a lender to get a loan. Mortgage brokers would sell the loan onto a bank, and the bank would hold on to it for the life of the loan or sell it to an investment bank. That investment bank could bundle it with thousands of other mortgages to create a larger asset they could use to make even more money. This is known as an asset-backed security. But things began to change in 2000. The dot-com bubble burst, and to help prevent a recession, the Fed aggressively lowered interest rates. Lower interest rates meant more people could afford to buy a house, so housing demand went up, as did prices and values. Higher home prices and an abundance of buyers brought in lots of money, and the lure of even greater profits enticed lenders to take on more risk with their mortgage loan products. Once fairly rare, adjustable rate mortgages and interest-only loans became popular. As long as home values were rising, buyers could refinance before the higher rates kicked in. Home equity loans let owners take money from the equity in their homes with the assumption that ever-increasing property values would cover the loan. Riskier still were subprime loans, mortgages made to borrowers with a low credit score. These borrowers paid bigger fees and higher interest rates because the lender assumed a greater risk for default. Problem is, mortgage brokers earned a fee from the bank for selling the loan, but had little incentive to maintain credit standards because it was the bank that actually funded the loan. From 2002 to 2007, banks underwrote $3.2 trillion in subprime loans. Now, instead of qualified stable mortgages going into the asset-backed securities, there were more and more vulnerable subprime loans mixed in. The asset-backed security supply continued to grow. By 2006, it had soared to $888 billion. Investment banks used asset-backed securities as collateral to borrow money, and their profits funded everything from credit card companies to retirement accounts. These securities were only as good as the mortgages themselves, and in 2006, a series of events started to unfold. Mortgage interest rates rose, and housing prices started to fall. The monthly payments on thousands of subprime loans increased substantially. Homeowners couldn't pay and couldn't qualify to refinance. People owed more than their house was worth. Mortgage defaults were way up. During 2007, nearly 1.3 million U.S. homes were subject to foreclosure. By August 2008, nearly 1 in 4 subprime loans had defaulted. The value of asset-backed securities nosedived, and banks were no longer able to borrow against the billions of dollars tied up in these assets. The result? Credit gridlock. The cash flow needed to keep the economy working was drying up and bringing down Wall Street. Main Street will soon feel the effects. Credit for auto, home, and student loans will be harder to get and cost more. The federal government has taken drastic measures. $700 billion in taxpayer money will be used to buy the troubled assets, bail out the banks, and hopefully prevent a total collapse of the U.S. economy.